That's a treasure hunt. And every now and then you find something, and occasionally, very occasionally, but it'll happen again. I don't know when. It could be next week. It could be 5 years off, but it won't be 50 years off. We will be bombarded with offerings that we'll be glad we have the cash for.
He didn't say if. He said when. And that single word is enough to stop every investor in their tracks. Look around the economy today. Housing is more unaffordable than ever. Interest rates are still high, and national debt is piling up. On top of that, investors are still chasing AI stocks like nothing can go wrong. It's a fragile mix, and Buffett knows it. That's why Berkshire Hathaway is sitting on a record-breaking $300 billion in cash. To some, that looks like hesitation. To Buffett, it's discipline. He's not rushing into overpriced markets. He's waiting for the day when value reappears. And by value reappears, I mean when the market corrects. And history tells us this isn't the first time. Before the dot-com bubble burst, Buffett was holding more cash than usual. Before the financial crisis, the same thing. Both times he wasn't predicting disaster, but his patience meant he was ready when disaster came. So here we are in 2025 with the biggest cash pile in Berkshire's history, an uncertain economy, and another hint from the most disciplined investor alive. And in this video, I am going to break down exactly what's going on, how Buffett is sending a strong message, and how using Buffett's three-step approach can help you make the most of it. Let's get back to it. If you want proof that Buffett's approach works, all you have to do is look back at the major crashes of the last few decades. Let's start with the dot-com bubble in 2000. Back then, everyone thought technology stocks could only go up. Companies with no profits, sometimes not even real business models, were being valued in the billions. When the bubble burst, trillions of dollars in wealth evaporated. Most investors panicked. They dumped their shares at massive losses. But Buffett stayed disciplined. He didn't chase the hype, and when the dust settled, he was able to buy real businesses at a discount. Fast forward to 2008. The housing market collapse triggered one of the worst financial crises in history. Stocks plunged, banks were failing, and people were convinced the system itself was about to collapse. Again, most investors sold in fear. Buffett, however, had cash. He stepped in with big investments in companies like Goldman Sachs, making deals that paid off massively in the years that followed. Then came the pandemic crash of 2020. In a matter of weeks, markets lost about a third of their value. It was chaos. But the pattern repeated. Panic selling on one side, patient buying on the other. Those who stayed in the market and kept buying came out ahead when the rebound arrived faster than anyone expected. And now, in 2025, we've already seen signs of an AI bubble overheating. Valuations in AI-related companies skyrocketed in 2023 and 2024. In some cases, like Nvidia, stock prices fell sharply after the excitement and expectations got ahead of reality. Many companies tied to AI haven't delivered profits, and expert surveys suggest a large share of AI investments are not yet yielding returns. Once again, the story is showing similarities: hype, over-exuberance, correction, and opportunity for those who are patient. Buffett's consistency through all of this is what makes his approach so powerful. He doesn't try to guess when a crash will happen. He doesn't even care about the exact timing. What matters is that he's ready when it does. That's why Berkshire is sitting on a cash pile larger than ever.
We'd end up doing better than if we did 50 and that we never concentrated enough. So that we would rather have, if we've got $335 billion now in treasuries, we would rather have conditions that are developed where we would have like 50 billion or something like that. But that just isn't the way the business works. And we have made a lot of money by not wanting to be fully invested at all times.
Think about what he's saying there. He's not interested in predicting the next crash. He's interested in being prepared for whenever it arrives. Because it always does. Markets go up, markets go down. That cycle never changes. What does change is how prepared you are to take advantage when everyone else is running scared. And that brings us to the first principle of Buffett's message, the importance of having a plan. If there's one thing Warren Buffett never stops repeating, it's this: know your plan. That might sound simple, but it's the difference between chasing the crowd and building real wealth. Buffett is an active investor. What that means is he's constantly analyzing businesses, studying financials, and waiting for the right opportunities to put money to work. He doesn't buy just because the market is going up, and he doesn't stop buying just because the market is going down. He buys when he finds value. That's his plan, and he's stuck to it for decades. But here's where most people get tripped up. They look at Buffett and think, well, if it works for him, I'll just do the same thing. That's the wrong move. Because the truth is, most people don't have the time, the patience, or the skill to invest like Warren Buffett. And Buffett himself says you don't need to copy him to succeed. Instead of trying to outsmart the market, you might be better off using a simple approach, what I call BHF, buy and hold forever. Here's a simple example. Imagine someone started investing just $500 a month into the S&P 500 back in 2000. Through dot-com crashes, the housing crisis, the pandemic, and everything else, they never stopped. By 2025, that investor wouldn't just have contributed $150,000. With growth and compounding, their account would be worth well over $500,000. Now, compare that to someone who's always trying to time the market. They wait for the perfect moment to invest, but markets don't give you a calendar. So most of the time, those people either sit on the sidelines too long, missing growth, or they jump in at the worst possible moment when hype is at its peak. Their results lag behind, not because they're unlucky, but because they never had a steady plan. Think of it like planting seeds. One by one, week after week, you put them into the ground. Some sprout quickly, others take longer. But given time, patience, and consistency, you will grow a few plants. Now, let's rewind to when Buffett himself had to rely on his plan. Back in 2004, he said something that puzzled a lot of people. Quote, "I found very few attractive securities to buy. At the time, the market was riding high. People thought he was being too cautious. Commentators even criticized him for being out of touch. But that was his plan. If the price didn't make sense, he didn't force an investment." Fast forward just a few years, and the financial crisis hit in 2008. Suddenly, those same people who thought Buffett was missing out were scrambling to survive. Banks were collapsing, stocks were crashing, and panic was everywhere. Meanwhile, Buffett had liquid cash and confidence because his plan gave him discipline. That's the part we forget. A plan isn't about predicting the future. It's about protecting yourself from being swept away when everyone else is reacting emotionally. And that's just it. The plan isn't one size fits all. If you love digging into companies and have the time and stomach for the ups and downs, you can be more active, like Buffett. But if you just want your money to grow steadily without stress, then BHF might be your best path. The danger isn't in picking the wrong style. The danger is not having a plan at all. Because here's what happens without a plan. You chase the market. You buy when things look exciting and prices are soaring. You sell when things look scary and prices are collapsing. And that cycle guarantees you'll always be buying high and selling low. Without a plan, the market plays you. Buffett avoids that by sticking to his discipline. Even now in 2025, with more cash than ever, he's not predicting disaster. He's not sitting on the sidelines forever. He's simply saying, I don't see good opportunities right now, so I'll wait until I do. That's a plan. And it's that plan that allows him to be ready when opportunities come knocking. Which brings us to the second part of Buffett's message, how to exploit openings when the market gives you a chance. Having a plan keeps you steady, but a plan alone isn't enough. Because eventually the world will hand you opportunities, and when it does, the question is whether you're ready to act. This is the second part of Buffett's message, knowing how to exploit openings. Buffett likes to use a baseball metaphor. In the stock market, you don't get called out for not swinging. You can stand at the plate for as long as you want, watching pitch after pitch go by. But every once in a while, you'll see the perfect pitch, the fat pitch, and that's when you swing. That's what cash is for. That's why discipline matters. You wait, sometimes for years, until the market gives you an opening, and then you move. Now, there are two types of openings Buffett talks about. The first are what I call capital openings, the big economy-wide downturns. The second are market openings, when individual companies get mispriced even while the broader economy is fine. Let's start with capital openings. The dot-com crash in 2000 was a perfect example. Back then, people were pouring money into any company with a dot-com in its name. Stock prices soared, not because the businesses were strong, but because everyone was chasing hype. And when the bubble burst, trillions of dollars in value disappeared almost overnight. Most investors panicked, selling at a loss. But disciplined investors used that moment to buy strong companies at bargain prices. Fast forward to today, 2025, and we've just lived through another version of that. The AI bubble. Artificial intelligence became the buzzword of the decade. Companies slapped AI-powered on their products, and their valuations got a boost. Investors couldn't get enough. But when reality set in, when many of those companies failed to deliver on their promises, the hype collapsed. Stocks took a beating. Once again, the people who chased the excitement got burned, while those with patience and cash had the chance to pick up real businesses at discounts. And it's not just bubbles. Look at the broader economy in 2025. Housing is unaffordable for millions of people. Inflation has eaten into savings. Interest rates are high, which makes it harder for debt-heavy companies to survive. These pressures don't mean a crash is guaranteed tomorrow, but they do mean that eventually opportunities will appear, and that's when you take advantage of them. Now, let's shift to market openings. These are smaller, but they can be just as lucrative. Sometimes a company's stock gets punished for reasons that don't reflect its true value. Maybe they had bad press, maybe their CEO resigned, maybe an entire industry falls out of favor even though the underlying businesses are strong. For example, Buffett has often bought companies after temporary setbacks, when everyone else was scared to touch them. In the 1960s, American Express was crushed by the salad oil scandal. Investors thought it was finished. Buffett saw its brand and credit card business were still solid, so he invested. That decision paid off for decades, and Berkshire still owns American Express today. Even policy changes can create openings. Take Trump's economic policies, for example. Love them or hate them, they often shake up markets. Tariffs, tax changes, or deregulation can hurt some industries while creating sudden advantages for others. If you're paying attention, these kinds of shifts can open temporary inefficiencies in the market, exactly the kind of opportunities Buffett is talking about. And this is where the lesson applies to you. You don't need to time recessions perfectly. You don't need to predict elections or policy changes. What you need is to be ready. If you're following BHF, buy and hold forever, that means continuing to buy no matter what. If you're more active, it means being disciplined enough to only act when you see a real opening. And that brings us to the third piece of Buffett's message, one that might be the hardest of all. Even with a plan and even with opportunities in front of you, none of it matters if you don't have the right attitude. This is where most investors stumble. It's not about knowledge. It's not about strategy. It's about emotions. Here's the reality. Markets are emotional. They swing between extremes of euphoria and despair. The media feeds this cycle because it sells attention. When markets are booming, you'll hear stories about how stocks can only go up, how we've entered a new era of endless growth. When markets crash, the headlines flip to doom and gloom. The world is ending. The system is collapsing. You should get out while markets are rarely as good as the hype makes them sound, and they're rarely as bad as the fear makes them feel. The truth is almost always somewhere in the middle. Let me give you an example. During the 2008 financial crisis, many investors panicked. They saw the headlines about failing banks and crashing markets, and they sold everything. On paper, they protected themselves from further losses. But in reality, many of them locked in their losses permanently. When the market eventually recovered, they were left on the sidelines, watching wealth they could have regained slip through their fingers. Or look at the 2020 pandemic crash. Within weeks, markets fell by nearly 20%. Fear was everywhere. Some investors dumped their holdings just to feel safe. Yet within a year, markets not only recovered, but hit new highs. The people who panicked lost out, while those who stayed calm or kept buying came out ahead. That's why Buffett keeps repeating the same lesson. Don't let fear or hype dictate your decisions. Both extremes destroy wealth. And the antidote is attitude, the ability to stay grounded when everyone else is losing their balance. Now, here's the part that really matters for you and me. Buffett's attitude works because it's built on preparation. He's not calm in a crisis because he's fearless. He's calm because he has cash, a plan, and the patience to wait. That preparation gives him the confidence to act when everyone else freezes. And this is where many investors misunderstand him. They think attitude is about willpower, about forcing yourself to stay calm when the market is burning. But in reality, attitude comes from structure. It comes from knowing your plan, knowing your rules, and sticking to them no matter what. So, whether your plan is active investing like Buffett, or buy and hold forever like most people should follow, the secret is to lock in that discipline. If your rule is to keep investing every 2 weeks, then do it whether markets are crashing or booming. If your rule is to only buy companies you understand, then don't chase the next hot trend just because it's in the headlines. So, what's the powerful message Warren Buffett is sending in 2025? It isn't that he knows when the market will crash. He's the first to admit nobody does. The message lies in what he's doing and the subtle signals behind it. Right now, Buffett is sitting on over $300 billion in cash, 27% of Berkshire Hathaway's assets. That's more than double the average he's held over the last quarter century. He hasn't done that without reason. In the past, moments like this have often come before major downturns, not because Buffett predicted them, but because he wasn't willing to overpay when deals weren't attractive. And each time, when markets eventually corrected, he had the flexibility to strike. Buffett is signaling us that opportunities will come, and they often appear when the rest of the world is panicking. He doesn't know if that's next week, next year, or 5 years from now, but he knows it will happen. Another signal? Selectivity. Buffett has been vocal about the difficulty of finding investments that meet his standards in today's environment. High valuations, rising interest rates, and shaky fundamentals in parts of the market have made him cautious. When Buffett says he isn't seeing enough value, that's a quiet warning. Not that disaster is imminent, but that investors should be careful about chasing inflated prices. So here is what you could do to be prepared. Have a plan, whether you're active like him or following BHF, buy and hold forever. Be ready to exploit both big downturns and smaller market openings. Keep the right attitude so you don't get swept up in hype or fear. That's how Buffett has navigated decades of market cycles, and that's how he's guiding Berkshire now. And here's the bigger point. This isn't just about billion-dollar deals. It applies to anyone willing to listen. Whether you're investing thousands or millions, the principles are the same. Stay patient, stay prepared, and stay disciplined. The opportunities will come. The only question is, will you be ready when they do? Buffett, in his most recent quarter, sold over $6 billion worth of stock. Click the video on screen to see which ones and why.